The Intelligent Investor by Benjamin Graham is a seminal work in the world of investing, often hailed as the Bible of the stock market. First published in 1949, the book has stood the test of time, offering invaluable insights and principles that have guided generations of investors. Graham, known as the father of value investing, presents a comprehensive approach to investing that emphasizes long-term strategies, thorough analysis, and emotional discipline. The book is divided into chapters that build upon each other, creating a cohesive narrative that educates and inspires. Let's delve into a detailed and engaging summary of this timeless classic, chapter by chapter. Introduction. In the introduction, Graham sets the stage for what is to come. He emphasizes the importance of distinguishing between investment and speculation. Investment, he argues, is an operation that promises safety of principal and an adequate return. Speculation, on the other hand, is focused on price fluctuations and carries a higher degree of risk. Graham's goal is to equip the reader with the knowledge and tools to become an intelligent investor, capable of making informed decisions and avoiding the pitfalls of speculation. Chapter 1: Investment and Speculation. The first chapter lays the foundation for the entire book by clearly defining the difference between investment and speculation. Graham argues that the true investor is concerned with the intrinsic value of a company rather than its market price. He introduces the concept of Mr. Market, a metaphorical figure who represents the irrational and emotional nature of the stock market. Mr. Market is prone to mood swings, offering to buy or sell stocks at varying prices based on his optimism or pessimism. The intelligent investor, Graham advises, should take advantage of Mr. Market's emotional fluctuations by buying when prices are low and selling when they are high. Chapter 2: The Investor and Inflation. In this chapter, Graham addresses the impact of inflation on investments. He explains how inflation erodes the purchasing power of money and how investors must account for this when making investment decisions. Graham emphasizes the importance of seeking investments that provide a return above the rate of inflation, ensuring that the investor's wealth is preserved and grows over time. He discusses various asset classes, such as stocks, bonds, and real estate, and their historical performance in inflationary environments. Chapter 3: A Century of Stock Market History. Graham provides a historical perspective on the stock market, examining its performance over the past century. He analyzes major market events, such as the Great Depression and the post-World War II boom, to illustrate the cyclical nature of the market. Through this historical lens, Graham demonstrates the importance of long-term investing and the folly of trying to time the market. He emphasizes that the intelligent investor should focus on the fundamentals of a company rather than being swayed by short-term market fluctuations. Chapter 4: General Portfolio Policy. The Defensive Investor. In this chapter, Graham introduces the concept of the defensive investor, who seeks to minimize risk and preserve capital. He outlines a conservative investment strategy that focuses on high-quality bonds and blue-chip stocks. Graham advises defensive investors to diversify their portfolios to spread risk and to avoid chasing high-risk, high-reward investments. He also stresses the importance of maintaining a balanced portfolio that includes both stocks and bonds, adjusting the allocation based on market conditions and personal risk tolerance. Chapter 5: The Defensive Investor and Common Stocks. Graham delves deeper into the defensive investor's approach to common stocks. He discusses the criteria for selecting high-quality stocks, including financial strength, dividend history, and earnings stability. Graham advises defensive investors to focus on companies with a proven track record and a strong competitive position. He also emphasizes the importance of dollar-cost averaging, a strategy that involves investing fixed amounts of money at regular intervals, regardless of market conditions. This approach helps to smooth out the effects of market volatility and reduces the risk of investing at peak prices. Chapter 6: Portfolio Policy for the Enterprising Investor. Negative Approach. In this chapter, Graham turns his attention to the enterprising investor who is willing to take on more risk in pursuit of higher returns. He outlines a negative approach to investing, which involves avoiding certain types of investments that are likely to underperform. Graham advises against investing in initial public offerings, IPOs, day trading, and chasing hot tips. He also warns against the dangers of leverage and the pitfalls of investing in companies with poor financial health. The enterprising investor, Graham argues, should focus on identifying undervalued stocks with strong fundamentals. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. Graham builds on the previous chapter by discussing the positive side of the enterprising investor's strategy. He emphasizes the importance of thorough analysis and research in identifying undervalued stocks. Graham introduces the concept of margin of safety, which refers to the difference between a stock's market price and its intrinsic value. The larger the margin of safety, the lower the risk of the investment. Graham advises enterprising investors to focus on companies with a wide margin of safety and to be patient in waiting for the market to recognize their true value. Chapter 8: The Investor and Market Fluctuations. In this chapter, Graham explores the psychological aspects of investing and the impact of market fluctuations on investor behavior. He discusses the emotional roller coaster that investors often experience, from the euphoria of a bull market to the despair of a bear market. Graham emphasizes the importance of maintaining a disciplined and rational approach to investing, regardless of market conditions. He advises investors to view market fluctuations as opportunities rather than threats, buying when prices are low and selling when they are high. Chapter 9: Investing in Investment Funds. Graham provides an overview of investment funds, including mutual funds and exchange-traded funds, ETFs. He discusses the advantages and disadvantages of investing in funds, such as diversification, professional management, and fees. Graham advises investors to carefully evaluate the performance and fees of investment funds before making a decision. He also emphasizes the importance of understanding the fund's investment strategy and ensuring that it aligns with the investor's own goals and risk tolerance. Chapter 10: The Investor and His Advisors. In this chapter, Graham discusses the role of financial advisors in the investment process. He emphasizes the importance of seeking advice from qualified professionals who have a fiduciary duty to act in the investor's best interest. Graham advises investors to be wary of advisors who prioritize their own interests or who promote high-risk investments. He also stresses the importance of educating oneself about investing, even when working with an advisor, to ensure that the investor can make informed decisions. Chapter 11: Security Analysis for the Lay Investor. Graham provides a primer on security analysis, the process of evaluating the financial health and prospects of a company. He discusses the key financial statements, including the income statement, balance sheet, and cash flow statement, and how to interpret them. Graham emphasizes the importance of understanding a company's earnings, debt levels, and cash flow in assessing its intrinsic value. He also introduces the concept of growth stocks and value stocks and the different approaches to analyzing each type. Chapter 12: Things to Consider About Per-Share Earnings. In this chapter, Graham delves deeper into the concept of per-share earnings, a key metric in evaluating a company's profitability. He discusses the importance of distinguishing between reported earnings and earnings quality, which refers to the sustainability and reliability of a company's earnings. Graham advises investors to be wary of companies that use accounting gimmicks to inflate their earnings and to focus on companies with consistent and growing earnings. He also emphasizes the importance of considering the source of a company's earnings, such as its core operations versus one-time gains. Chapter 13: A Comparison of 4 Listed Companies. Graham provides a case study of 4 listed companies, comparing their financial performance and valuation metrics. He discusses the importance of comparing companies within the same industry and with similar business models. Graham emphasizes the need to consider both quantitative and qualitative factors in evaluating a company, such as its management team, competitive position, and growth prospects. He also discusses the concept of relative valuation, which involves comparing a company's valuation metrics to those of its peers. Chapter 14: Stock Selection for the Defensive Investor. In this chapter, Graham outlines a stock selection strategy for the defensive investor. He emphasizes the importance of focusing on high-quality companies with strong financial health and a proven track record. Graham advises defensive investors to consider factors such as dividend history, earnings stability, and debt levels in selecting stocks. He also discusses the concept of diversification, which involves spreading investments across multiple companies and sectors to reduce risk. Chapter 15. Stock Selection for the Enterprising Investor. Graham turns his attention to the enterprising investor, providing a stock selection strategy that focuses on identifying undervalued stocks with strong fundamentals. He emphasizes the importance of thorough analysis and research in uncovering hidden gems in the market. Graham advises enterprising investors to consider factors such as the margin of safety, earnings growth potential, and competitive position in selecting stocks. He also discusses the concept of special situations, which involve investing in companies undergoing significant changes, such as mergers or restructurings. Chapter 16. Convertible Issues and Warrants. In this chapter, Graham provides an overview of convertible issues and warrants, which are types of securities that can be converted into common stock. He discusses the advantages and disadvantages of investing in these securities, such as their potential for capital appreciation and the risks associated with conversion. Graham advises investors to carefully evaluate the terms and conditions of convertible issues and warrants before making a decision. He also emphasizes the importance of understanding the underlying value of the common stock into which these securities can be converted. Chapter 17. For extremely instructive case histories. Graham presents 4 case studies of companies that experienced significant market fluctuations, providing valuable lessons for investors. He discusses the importance of maintaining a long-term perspective and avoiding the temptation to react to short-term market movements. Graham emphasizes the need to focus on the fundamentals of a company rather than being swayed by market sentiment. He also discusses the concept of mean reversion, which refers to the tendency of a company's stock price to revert to its historical average over time. Chapter 18. A comparison of 8 pairs of companies. In this chapter, Graham provides a comparison of 8 pairs of companies, each pair consisting of one company that outperformed the market and one that underperformed. He discusses the factors that contributed to the success or failure of each company, such as management decisions, industry trends, and competitive position. Graham emphasizes the importance of understanding the underlying drivers of a company's performance and the need to consider both quantitative and qualitative factors in evaluating a company. Chapter 19. Shareholders and Management's Dividend Policy. Graham delves into the relationship between shareholders and management, focusing on dividend policy. He discusses the importance of a company's dividend policy in signaling its financial health and growth prospects. Graham advises investors to consider factors such as dividend yield, payout ratio, and dividend growth rate in evaluating a company's dividend policy. He also emphasizes the need to balance the desire for current income with the need to reinvest earnings for future growth. Chapter 20. Margin of Safety as the Central Concept of Investment. In the final chapter, Graham reiterates the importance of the margin of safety concept in investing. He emphasizes that the intelligent investor should always seek to minimize risk by focusing on investments with a wide margin of safety. Graham advises investors to be patient and disciplined, avoiding the temptation to chase high-risk investments in pursuit of quick profits. He also stresses the importance of continuous learning and self-improvement in becoming a successful investor. Conclusion. The Intelligent Investor by Benjamin Graham is a timeless classic that offers invaluable insights and principles for successful investing. Through its detailed and engaging chapters, the book provides a comprehensive guide to navigating the complex world of the stock market. Graham's emphasis on long-term strategies, thorough analysis, and emotional discipline serves as a reminder that investing is not a game of chance, but a disciplined pursuit of value. By adhering to the principles outlined in this book, investors can build wealth and achieve financial security over time. The intelligent investor, as Graham envisions, is one who combines knowledge, patience, and discipline to make informed decisions and avoid the pitfalls of speculation. In an ever-changing financial landscape, the wisdom of the intelligent investor remains as relevant and insightful as ever.